We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Dave Kranzler from investmentresearchdynamics.com. He's also the author of the Mining Stock Journal and Short Sellers Journal. Thanks for joining me today, Dave.
Tom, thanks for having me on again. It's good to see you again.
Good to see you too. And you're crystal clear today as you just got a new webcam, right?
Yes, this is the debut of my new webcam. I got tired of taking a bunch of heat from viewers who are like giving me a hard time about the quality of my laptop camera.
Well, hopefully that doesn't change the quality of the information that you're presenting.
I agree. That's what I usually respond with. They don't care.
Well, maybe they just want to see your pretty face, Dave.
I don't know who would want to see that. Listen to the podcast when you're walking the dog or something. Then you don't have to look at the video. That's what I do.
So, Dave, it's been a while since you've been on the show, but it's been good to catch up with you here. And we have a lot of topics that we kind of touched on before we hit record here today. But I'd like to start with kind of the way you see the more general side of things. Considering that most economic data is retrospective, is it possible that the majority of U.S. households are already in recession? Well,
that's my view just from looking at the data, and I've been talking about that for quite some time. And in fact, I would argue that because I look at the weekly economic data, the relevant data every week, as I'm doing my research, preparing for my weekly Short Sellers Journal. And, I don't just look at Zero Hedge and look at the headlines. I want to go and look at, if I can, the source documents and dig below the headline numbers. If you just look at the headline numbers that they report on Bubble Vision or CNBC or whatever, you're going to get a completely different picture of a lot of these economic reports than if you actually go in and pull apart the data that goes into making up the headline numbers. So, I would say that outside of the stimulus payments that were the stimmy checks that were passed around twice between March 2020 and I guess January 2021, I would say that 80% of all U.S. households, at least 80%, have basically been experiencing a recessionary economic environment. And the advent of raging price inflation has just magnified that for them. Mm-hmm. And I think it's starting to filter into, probably the under top 10% wealth and income demographic. So, and as an example, like you see these reports, savings are at blah, 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 record level savings. Well, they don't break that out by wealth demographic. As it turns out, the majority of that savings is held by the top 1%. And if you can actually see it in the numbers, if you go back to last summer, which is essentially when it's estimated that most people had gotten done spending their stimmy checks, you can actually see where, like, starting in May, June, July of 2021, you can actually see a lot of the hard economic data start to head south, and a lot of the sentiment data. Mm-hmm. And so, I would say, at least for the last year, the majority of households in this country are would tell you that we're in a recession.
So what is some of that data that you're looking at that shows you that picture? Could we even look at something like household credit card debt?
Yep, you can look at that. It's a little bit trickier to analyze because it tends to be volatile. Mm-hmm. But recently, in the last couple consumer credit reports put out by the Fed, you can see the use of credit card debt has spiked up to, on a month-to-month basis, it's spiked up to record month-to-month changes. And the theory, sorry about that. The theory on that is that a lot of households now have to, because of price inflation, a lot of households have to use their credit cards to make ends meet every month.
Mhm.
So, and at some point they're going to run out of their credit card limits. Retail sales is another one, and obviously there's a huge diversion between nominal retail sales that, the headline numbers that everyone reports and real retail sales. And I even look at what I call real retail sales. So you got real retail sales, which would be the nominal headline number, and remove CPI inflation out of that number. And that essentially, in theory, gives you what unit sales. Let's just say widgets. So on a month-to-month basis for the last few months, the number of widgets that are being sold each month has been flat to down. Even though the headline number shows nice growth in retail sales. Well, it's all inflation. Mm-hmm. And then if you actually use the shadow stats alternative inflation number, which is a much John Williams calculates inflation. His alternative measure is how they calculated it in 1980, which is when they really first started messing around with dumbing down the CPI index. And the latest through the latest CPI report, what I call real inflation has been running at closer to 16 or 17%. And I think that is probably, I know for me, that's more close to the type of inflation I've been experiencing over the last year. And I think most people would say that. And I'm not even, take gasoline out of the equation. If I go to the grocery store or, any number of things, streaming, content streaming memberships, things like that. I mean, it's all increasing at double digits. So if you strip real inflation out of the retail sales number, I mean, the retail sales industry in general is in a pretty bad recession right now. Mm-hmm. So that's an example of the type of things I look at.
So when we think about all of the pieces of that puzzle, obviously the Fed is a big part of that. And I saw you say the other day that you think the Fed won't start QT, quantitative tightening. So is that because you think that the markets are going to start to feel too much pain before the Fed has to basically reverse course on being hawkish here?
Well, I mean, I don't want to backpedal from that. I'm just saying, when I say I don't think they'll start QT, mm-hmm. which would be start to remove the liquidity they injected into the financial system, really the banking system, over, since March 2020. I think there's a good chance they won't. I mean, they may just because if they flinch on that threat, I mean, the U.S. dollar is going to head south very quickly. And they've got to. I mean, when you think about it, who's going to buy? We're going to have a ton of Treasury issuance coming. I mean, the government spending deficit just keeps getting larger every month. And I think they're going to be surprised at, the amount of tax, other than maybe capital gain, tax revenue from capital gains. I think they may be surprised at I think the amount of tax receipts that they ultimately end up collecting this year are probably going to be lower than they expected. Mm-hmm. So I expect the spending deficit to really widen out this year, and they're going to have to issue more debt to fund that, right? Mm-hmm. So who's going to buy that debt? I don't know. I mean, I don't think the Japanese are, unless the yen starts to move up again. I was reading an interesting article, I think it was just yesterday or over the weekend, that was talking about the cost to hedge out the currency risk is offsetting the benefits from doing the yen treasury carry trade. So mm-hmm. Unless they don't care if the long end of the curve goes a lot higher, which would make it a lot more expensive for the government to finance its deficits, someone's going to have to buy those treasuries, and I don't know who's going to do it besides the Fed. Mm-hmm. And I also think that there's potentially a big credit accident, a credit market accident that's out there looming. And the reason I say that, if you pull up a 1-year daily chart of Deutsche Bank, mm-hmm. I mean, Deutsche Bank stock that's probably the most systemically dangerous bank in the world. And it's already been saved once by the Western central banks and the German government. And I mean, that stock has literally fallen off a cliff. And to me, that's emblematic of major problems behind the curtain going on in the credit markets. Mm-hmm. And if you look at the MOVE index, which simplistically, the MOVE index is basically the VIX for the bond market. I mean, okay. The MOVE index is, and this is something I've been watching every day. I mean, the MOVE index is almost at a 1-year high, and it's been steadily moving higher since September of 2021. And that basically reflects the growing risk in the bond market. Mm-hmm. And it's not so much because interest rates are going higher, it's because the credit quality of corporate credit is deteriorating quickly. Mm-hmm.
Well, it's interesting to, you mentioned the US dollar going down here because of in some ways a lack of demand. And, I spoke to Jeff Christian within the last couple of weeks here, and something I would like to get into is this, this real monetary shift that we can see is underway here. But he had brought up the point that there isn't any other currency that has the liquidity to be able to use as the reserve currency. So do you think that we could see the US dollar continue to appreciate simply because of the lack of liquidity for any of these other currencies to be able to support and take over reserve status at the drop of a hat in some ways?
I don't know if I agree with that argument. I don't know that China would agree with that argument. Mm-hmm. I mean, the only reason that the U.S. dollar has so much liquidity is because the Fed has created so much of it in the last 2 years, mm-hmm. more than any other central bank. And I was looking at, this is off the top of my head, so take it with a grain of salt. But I was looking, there was a report out last week, and it was talking about how I think it's call it over the last 10 years. If you look at central banks globally, say 10 years ago, I'd have to pull it up to get the numbers exactly. So I'm just using 10 years as a placeholder for the time. But the amount of dollars that were held as currency reserves by central banks globally was like 38%, mm-hmm. and now it's down to something like 16%. So, when you have a shift as we're seeing, that's where the world has been slowly and gradually shifting away from the dollar as the reserve currency. It's not going to happen overnight. Mm-hmm. But I mean, we've been seeing this development, especially, if you're an avid precious metals market follower, as I am, and I know you are. I mean, we've been seeing that, countries like China and Russia have been using their own currency for bilateral trade, more so China than Russia. Russia recently, because they've been forced into it. Mm-hmm. But China's been using its currency in bilateral trade for quite some time now. And they're not going to do it all at once. They can't do it all at once. And the genius of smashing Bretton Woods and making the dollar as a fiat currency, the reserve currency, was pegging the value of the dollar to oil, the petrodollar. Well, that's falling apart now. Mm-hmm. And we're seeing that, for instance, when Xi Jinping canceled his trip to go see Biden and went over to see, the El Jefe in Saudi Arabia, MBS or whatever they call them. And, they basically, it sounds like they started talking about trading oil for yuan. Mm-hmm. And so, that this type of thing happens slowly over time, and then it's going to suddenly happen. Mm-hmm. And so I think the liquidity argument is just grasping for straws, for people who derive their power and want to continue benefit from having the dollar as the reserve currency.
Is it possible that China in some ways has to be relatively more careful considering how big of a trading partner they are with the US?
I think that statement was probably more correct 10 years ago than it is now. I mean, I've been watching it for the last 10 or 15 years, and a lot of people have been. I mean, one of the things that China's been doing systematically is increasing the size of the trading markets over in Asia. So, whereas, say from the mid 1990s until, just to pull the date out of the air, 2010, they were predominantly reliant on trading with the US. Well, now, I haven't seen the numbers, I haven't tried to look for them, but I know now that as a percentage of their overall trade, they're doing a lot more trading with the rest of the world, and particularly the Eastern Hemisphere world, relative to the US than they would have been doing 10 or 15 years ago. So, again, it's the type of thing where they can't just push a button and change it overnight. Mm-hmm. And it just from a strategic standpoint and a diplomatic standpoint, they wouldn't want to do that. I just think structurally it'd be impossible to do, but it's been happening slowly over time.
Mm-hmm. So, Dave, I've heard you speak before about the Achilles heel of the banks in the West as being the metals market. So why is this, and what factors do we need to see for this to start to unwind?
That's a great question. It's the derivatives side of the metals market is the Achilles heel. And it's because if I look at, and a lot of people look at the gold and silver markets as being bifurcated, where you have a physical gold and silver market, and then you have on the other side, you have the paper derivatives market. And the size and scale of the paper derivatives market just completely dwarfs the size and value of the underlying physical gold and silver market. And it's a big Ponzi scheme on the derivative side, because what they rely on is that the investment audience that loads up on derivatives. And I'm talking about everything from Comex futures, LBMA forwards, gold lease central bank gold lease transactions. And then there's a whole other category of OTC derivatives, gold and silver derivatives. And no one knows, what the nature of those contracts are, other than that they're large. In aggregate, they're large. And so what they rely on is that the investors who go long the derivative side are never going to exercise the embedded option to actually take delivery of the underlying physical commodity, the underlying gold and silver. And if they do decide to take delivery of it, they hope that these people, these investors, leave that metal that they supposedly have delivery of in the vaults of the banks in London or the Comex vaults. So what their worst nightmare is that if a lot of large investment funds decide, oh, you know what, I think this time I want to take delivery of my underlying gold or silver, but I don't want to leave it in your vault, even though you're offering me a much better storage rate than I would at an outside the Comex private facility, or then it would cost me to build my own storage facility and safekeep it myself, which is what I would recommend. Their worst nightmare is if investors start to take delivery of the underlying metal and remove it from these vaults, from the bank vaults in London and New York, because then that's when I think you'll start to see, if it happens en masse, and I call it a run on the vaults, mm-hmm. Like a run on the bank. If that starts to happen en masse, that's where I think you'll see these banks have huge holes blown in their balance sheet from defaulting on the ability to deliver the gold and silver.
So isn't it, though, that the way the Comex works, Dave, isn't it the seller that can settle for cash or basically dictate the terms of the actual contract, whether to be able to deliver?
Not at this point. It's the seller can offer that, and if the buyer or and technically it's the
The
stopper, the person taking delivery. If the person taking delivery wants the physical, they have to settle in physical. I assume it's the same with LBMA forwards, but that's how it is on the Comex.
Okay.
There is force majeure clause where they can settle for cash, or there's these other, these things that you see, the PNTs, the privately negotiated transactions, and the EFPs, the exchange for physicals, which really aren't. It's still a derivatives transaction. If the stopper says, okay, I'll what they do is they sweeten the deal to get them to agree to a PNT or an EFP transaction, and the person on the receiving end, the stopper, is like, yeah, I'll agree to that. Well, there's not really any metal that actually changes hands, and there's not any metal leaving the vault system in London or in New York. So it's when the people who are entitled to take delivery start removing it from the vault system. That's where I think you start to see a lot of problems.
Mm-hmm. So, Dave, after the Fed meeting last week, we saw nearly everything from the general equity markets to the metals, cryptos, and even the miners take a real hit last week. So from your perspective, how do you observe this market behavior? Is it possible that the metals aren't a safe haven that we think they are?
Just really quickly, just to back up for a second, just to kind of punctuate my point on the previous topic. What we saw in the nickel market several weeks ago, that's the type of thing that I'm talking about that could happen in the gold and silver market. And I think it will eventually happen. Mm-hmm. So that's the dynamic I'm talking about. And it's, the nickel market's small compared to the gold market. And so, and that, if it happens in the gold and silver market, you don't want to wish ill will on people, but it'll transfer a lot of wealth to people who actually own physical gold and silver.
Well, how has that the nickel trade and that in some ways that nickel squeeze played out? Has it now settled at a much higher level, or has it resumed trading? Because I know it was stopped for quite a while.
To be honest, I kind of got bored with the story and I stopped following it. I think JP Morgan basically smoothed things out behind the scenes. Mm-hmm. And I would assume nickel's still trading on the LME, but I don't know for sure. There's just been so many other things to keep an eye on, including, obviously Tesla, which we were talking about. But to get back to answer your question about does the action in the precious metals sector and gold and silver that we've been seeing, does that mean that gold and silver aren't they're not a
safe haven asset?
A safe haven or wealth preservation or negative beta asset? And I would say no, that's not what it means, because if you the action that you're seeing on your screens in the gold and silver market, it's happening almost entirely in the paper derivative side of the precious metals of the gold and silver markets. It's not like, I haven't heard of any big physical gold holder all of a sudden saying, hey, I'm going to sell my gold holdings because I'm freaked out because gold's going straight south. Mm-hmm. You're not seeing that in silver. In the past, when we've seen these periods where the price of gold and silver gets whacked hard in the derivatives market, the derivative side of the market, that's actually stimulated buying. And a good example is India. Now, I subscribe to a newsletter, John Brimlow's Gold Jottings, or JB's Gold Jottings, whatever he calls it. It's kind of an expensive newsletter, but it comes out twice a day, and he tracks the physical markets around the world. And I can hook you up with him if you want to interview him. He'd be a fascinating interview. And one of the, a key market for physical gold buying is India. Mm-hmm. They're, in any given year, either India or China is the largest gold importer over a 1 year period. And since the way their pattern is when the price of gold shoots up like it has, up until last week, when it gets, especially over the last couple of years, when it's gotten into the high 1900s or even over 2000, they stop importing. They're price sensitive. and they'll stop importing for a while. And you can see that the data that he presents and reports shows this. And India has been pretty much dormant, absent from physical importation, other than probably smuggling over the last 6 to 8 weeks. Well, just yesterday, and as the latest missive from JB, all of a sudden it looked like the price had gotten low enough relative to supply and demand over there right now, and relative to the import duty tax that's assessed, that the public was willing to pay enough for gold to make importation feasible again. So if anything, this latest smack on the paper side of the gold market has re-stimulated Indian demand. So, and I haven't gotten the second market update today. That'll come later. So I don't know what happened last night in India, but I'm assuming they were probably importing gold. So if anything, what happens when you see these waterfall declines in gold and silver, it's shock and awe, but over the last 5 or 10 years, if anything, it's been stimulating buying. With silver, it stimulates retail buying. And with gold, it stimulates the large physical buyers into buying. So again, I think really what we've seen over the last couple of weeks in the sector is the action that's going on in the derivative side of the market. And the stocks are, gold and silver mining stocks are derivatives of gold and silver in a sense, right? So, and also, the stocks are part of the stock market, and we've seen this action several times over the last 20 years when the stock market's about ready to crack. The gold and silver stocks get cracked first, and we saw that last week, right? GDX all of a sudden fell off a cliff a day ahead of when the stock market started falling off a cliff again. We saw it in February 2020. GDX headed south, on a lagged, and that the stock market headed south after GDX on a lagged basis. Saw the same thing in the summer of 2008. All of a sudden in the spring and early summer of 2008, the entire precious metal sector started heading south. The stock market had been in a downtrend, but it took another step down late that summer and early in the fall. So again, as with Deutsche Bank, where to me it's an indicator of the relative riskiness and the potential problems developing in the credit markets. When I see the mining stocks get cracked the way they did last week, I'm like, the stock market's going south. And so that's what we're seeing in this sector. And at some point, and I don't know when, at some point, I think we'll start to see the mining stocks and gold and silver start to do a U-turn. The last time over the last, 3 or 4 months when gold got smacked, it traded down to 1880. Right now, I think the bottom has been, 1892. So we'll see if it goes below 1892, maybe it tests 1880 again. But as soon as it got into the low 1890s, it's been in an uptrend since, 9 p.m. last night, East Coast time. So, and it's above 1900 now. And if gold starts to head higher, at some point, silver's going to follow it.
So Dave, having the advantage of watching these markets for as long as you have, you were mentioning to me before we hit record today that this exactly the type of market action we were just discussing really reminds you of some of the most durable moves in the gold sector. So can you tell us a bit more about, how you're seeing that develop?
Yeah, well, I want to say the move that we've seen, and as I mentioned, gold actually, if you look at a chart, gold actually, it peaked in August 2020 as did the mining stocks, and then went into a downtrend, and gold hit the bottom of that downtrend actually in March 2021. It went sideways until, again, I'm doing this off the top of my head, I have to pull up the chart, but I think it started heading higher in July 2021. The mining stocks were, and I'm just using GDX as a proxy. the mining stocks, GDX went a little bit lower after July of last year, and then it bottomed and started to move higher. And at least what I've observed over the last 21 years is that when you start to go in, when a bull leg, because we're in a secular bull market in the precious metals sector that started in late 2000, early 2020 or early 2001, and I think it has quite a bit longer to go. But then you have up and down cycles within this overall secular bull market. I mean, through today, if you measure it from the beginning of 2001, gold has been the best performing asset versus major financial assets, especially the Dow, the NASDAQ, and the S&P. So the bull market's still intact. There's still a very long 21 year uptrend in the sector. But the longest and most durable bull cycles in the sector have occurred when gold starts to move higher slowly ahead of the rest of the sector. And then at some point, large investors start to notice that, and then they start throwing money into the largest cap gold stocks. And we've seen that, especially with Newmont and somewhat with Barrick. We would have been seeing it with Agnico Eagle if they didn't issue a lot of shares to take over Kirkland Lake. But that'll clear once that clears the market. I expect Agnico to outperform Barrick and Newmont, and some of the other largest cap stocks. One of my favorites to trade is Gold Fields and Anglo Gold Asante. So those stocks have all started moving higher. Newmont hit an all-time high, about a week and a half ago. And then what happens is, more speculative capital starts to pile into the mid-cap producers, the smaller cap producing stocks. So obviously they're less risky than the junior exploration stocks. And we've started to see that. Again, I was looking at the chart last week when I was starting to work on my next issue of the Mining Stock Journal. And you look at the chart, lo and behold, gold started moving up last summer. GDX started following it. Silver started moving higher after that. And then GDXJ started moving higher. And I don't consider GDXJ a junior ETF. For me, the junior mining stocks are the micro cap, I call them venture capital exploration stocks, business development stocks. And those are always the last to move. And you've seen it in select instances, but you haven't really seen it yet. To sort of contrast that with what's happened since 2015, when everything bottomed from the 2011 peak, the junior stocks just raged between the beginning of 2016 and they peaked in July 2016, and then we had a vicious pullback, and that's because you had all this speculative money, chasing the momentum that was created. And they were all piling into the junior mining cap stocks. And there were like eye-popping returns during that 6-month period, 7-month period. But then, the market gave a lot of it back as the speculative money all of a sudden fled and decided to go chase tech stocks. And then we saw that again when the market bottomed in March 2020. The entire sector had incredible returns between March and August. And especially some of the junior, the riskiest stocks. To me, those weren't healthy moves. And I thankfully I resisted the temptation to go all in chasing them. Of course, I tried to take advantage of it, but it wasn't like I piled into it the way these momentum traders do. And so those were 6-7 month moves. In the case of 2020, less than 6 months, those aren't durable moves. Those aren't the kind of moves I want to see. And everything all went up at once. And now to contrast that, the cycle's been kind of playing out the way I want to see it play out. And the same thing happened in 2008 when the sector got creamed, bottomed out, and started moving higher. And that also illustrates the point to your other question about, how come the mining stocks aren't behaving like wealth preservation vehicles right now. Well, at some point they will, and we saw that in starting in November of 2008. The mining stocks started going north, and the S&P kept going south and didn't bottom until I think it was late March 2009. And the only reason the S&P bottomed was because the Fed was printing money and dumping it into the financial system. So that I think that's the kind of cycle that we're in now. I think we're in the type of cycle that is going to be long and durable. And if I'm right, and obviously I could be wrong. I don't know. I'm not saying I'm right, but if you say this cycle started in, let's just say, late summer 2021, we probably have at least a couple years for this whole thing to play out and move higher.
And when you see that speculative or that hot money move in, is that usually a signal for you, Dave, to kind of take some profits and be able to, get some perspective on some of these shorter rallies?
No, man, surf's up, dude. Ride the wave. Yeah, you hit the nail on the head. It's not like they're going to shoot up to Pluto. They're not going to do a Roman candle and shoot up and go straight down. I mean, that's when you probably want to start slowly selling into it. Mm-hmm. So that's how it works out ideally. But of course, greed gets the better of all of us, and you don't completely remove your exposure, but and you're not trading it or investing in it aggressively enough if you don't give back a little bit at the end when a cycle is over. And no one times a market perfectly. And people who say they do, they're lying, or they got lucky.
So, Dave, we mentioned the amount of demand that we've seen, let's say over just say the past 2 years for physical. So when do you think that record demand starts to catch up with supply and stockpile, like above ground stockpiles?
Well, when you say demand, are you talking about retail demand?
We could break that apart however you'd like to, because obviously you're talking about demand from India. I guess we could break it apart for retail demand, central bank demand, however you'd like to.
Right, and so I mean, keep in mind that in the supply and demand equation, I mean, there's supply that's added to the market every day, right? I mean, these mining companies are turning out gold and silver doré bars on a daily basis. Mm-hmm. And this is just a working theory I have. I think that the retail demand, for minted bullion products, I think that's a decent proxy for a small of demand for a small part of the market. But the entities that supply gold and silver to the mints can regulate that supply, and that's why you start to see and read about shortages of minted coins, because they say they can't get silver blanks to make silver eagles. Well, that's nonsense, because supposedly the Comex is sitting on plenty of silver. Just go and contract to take delivery of silver off the Comex and send it to your refiner to make the blanks and do it. But that's not how it works. So my theory is that when there's stress on the physical market because Eastern Hemisphere buyers are buying a lot of physical gold and silver, I think they kind of regulate or cut off the supply to the retail side via the mints. Mm-hmm. And we've seen that. I mean, we saw it happen in 2020, right? Remember that there was that whole big issue in March 2020 with supply of gold bars on the Comex and in London. And I, for a while, it looked like there might be a default, but there wasn't. They layered on another paper derivative product, the so-called ACE contracts that let the Comex and the LBMA simplistically to explain it, kind of pool their gold to make deliveries. And again, as long as that gold stays in the vault and the investors don't remove it from the vault, they can keep getting away with the scheme. I think what they work hard to avoid is a big delivery default to the large big boy buyers, I call them, whether it's a massive wealth fund or a wealthy individual, or defaulting on deliveries to India or China or Russia. Mm-hmm. And I think they'll do whatever it takes to make sure that they can continue, that deliveries can continue uninterrupted into the big boy buyers. And it's if we ever hear about a default or a problem making deliveries into the big boy buyers, I think that's when the game's over. The manipulation game is over.
Yeah, and I guess that would make sense considering that the big boy buyers are the last ones to avoid getting delivered to, right? We have to think about the length of the supply chain and length of time that it would take to make rounds to be able to deliver to the mints. And obviously, I think that would be the first place that you would see that tightness develop over the real, let's say the big money contracts that are going back and forth, right?
That's right. And, up to this point, if there's been a shortage of supply, they've been able to fill that by, using gold swaps. The BIS does these transactions called gold swaps, and it essentially makes physical gold available in the 400 ounce bar form available to the bank so that they can send them to Swiss refiners where they refine them into kilo bars and ship them into China. Mm-hmm. And so the central banks, the Western central banks, kind of pool the bars that they have in their vaults. And again, it's questionable as to whether they actually have title to these bars, but they lease them out, they swap them out, and that's how they've been able to. There's a whole school of us that believe that GLD and SLV are used as liquidity provisions when there's shortages of physical and they need to put out, I call them delivery fires around the world. They just borrow bars from the SLV and the GLD vault. So, no one really knows what's really going on inside those vaults, and that's intentional.
Mm-hmm. Yeah, absolutely. Dave, of course, on your Twitter, you talk a lot about Tesla and some of these shorts.
I do.
And of course, we've all heard about how Elon Musk bought Twitter, but how does this affect and leverage Tesla? And how do you see this maybe playing out for Tesla's share price?
It's not playing out well today, is it? The share price is down over 10%. Again, this is just one of my theories, and I don't know that it's unique to me, but mm-hmm. it was kind of the first thing I thought about when all of a sudden, what was it, last Monday, I think it was, or 2 Mondays ago, whenever it was, all of a sudden you wake up and there's a headline, Musk is considering making a bid for Twitter. Well, not coincidentally, about an hour later, a headline hit the tape that didn't get as much recognition or attention, that the Justice Department and the SEC had initiated a joint investigation into Elon Musk's market activities and tweeting activities. And I think part of what Musk is doing is kind of a shock and awe stunt to deflect away from what's really going on at Tesla. There's been a lot of bad news that has poured out of Tesla over the last 2 weeks. We had the Shanghai factory shutdown, closure. It's taken away at least a month of production from Tesla, and that's just going to kill their financial results. They've had.
What was the reason for the shutdown? Sorry, Dave.
In Shanghai, it's the COVID.
Okay.
They've shut down all of Shanghai to, I know there's conspiracy theories out there about what the CCP's motive is. I don't know if they're true or not. I don't really care. I just know that, I don't even know if Tesla's factory is up and running right now over there, but I know it was shut down for 3 or 4 weeks.
Okay.
There were 2 large recalls of Teslas, one in Europe and one in China. The European recall is it affects something like 400,000 Teslas, and it's not like a tech related recall where they can fix the software glitch over the air. The cars have to be taken in. And what happens is, and we knew this was a problem for a long time. It's always been advertised, and people have whined about it. I guess they're called frunks, but the front hood of the Tesla at high speed starts to rattle, and it doesn't clamp down properly. The clasp on it's defective, and the concern is that at high speeds, the hood might fly off, or frunk, whatever you want to call it, might fly off. And how'd you like to be driving behind a Model S going 80 miles an hour or 100 miles an hour on the Autobahn, and all of a sudden the hood of that car flies off, smashes into your windshield? So there's been that recall. There's been the Justice Department SEC investigation. There's just been a whole plethora of bad news that's been out there connected to Tesla that's been buried because Musk is, he's been able to deflect attention away from it with this Twitter stunt. And I mean, who knows what his real motive is? I mean, a lot of people are championing this idea that, he's going to turn Twitter into a pure free speech platform. And I don't believe that, because he's not a good guy. He's not a altruist. If anything, he's a misogynist. I mean, people don't realize this, but I mean, there's a whole docket of civil lawsuits filed against Tesla for all kinds of reasons. Obviously, the racism at the Fremont factory. I don't know if you saw the news about that, but yeah, there's been allegations that managers at that factory are racist, and with specific examples. I mean, Twitter was just flush with accounts of it. So there's lawsuits connected to that. Musk doesn't care about the safety of people. There's all kinds of defects with his vehicles, and there's been all kinds of recalls over the years. So I don't know why people think all of a sudden he's going to become this altruistic guy who cares about free speech. For him, it's about control and making as much money as he can for Elon. He doesn't care about anyone else. So I don't really know what his motive is with this Twitter takeover. I don't know if it's going to succeed. I haven't had a chance to look at the filings yet, but apparently he's pledged up to 84% of his stock holdings to get this deal done. And if the price of Tesla goes low enough, he's going to lose all his stock. Part of me actually thinks that one of his motives for this is that it gives him an avenue to monetize his Tesla holdings without actually selling the shares. Because if he just started selling the shares like Jeff Bezos sells Amazon, every month, the automatic sale thing, people would be like, what's up with that? Why is Musk all of a sudden, why does he want to sell his shares all of a sudden? And it would adversely affect the stock price. So,
that's an interesting take on it.
Don't know that it can be any more adversely affected than it is today, down 10%. But I mean, we'll see. This is definitely, get your popcorn popped and have a lot of it, because this will probably take a while to play out, but it's going to be interesting to watch.
Yeah, and of course we're talking on the morning of the 26th here. So just to give our listeners some perspective on the day that we're speaking. But you had mentioned to me earlier that we could kind of see the end of so much, let's say, corruption, and the SEC really starting to crack down again. Of course, it's been a long time since we've seen anybody really go to jail for that. So can you share with our listeners why you see these financial risks start getting wound down?
Well, I mean, that's a great question. And when you have stock bubbles, it foments fraud and corruption. And it seems like with each successive stock bubble that we've had, the SEC has been less involved in enforcing the regulations. And now it gets to the point where they don't pounce on a fraud operation until after it's already blown up. Madoff is the perfect example. Harry Markopolos famously put a case publicly in the SEC's lap in 1998 or 1999, that would have shut down Madoff back then. And the SEC looked the other way, and they didn't, Madoff's Ponzi scheme didn't start to blow up until 2007, I think. And that by that point, the bubble that had formed, say between 2003 and 2007, was starting to pop. And so what happens is you get these stock bubbles, fraud perpetuates, the regulators look the other way. A lot of them have self-interest in seeing the fraud perpetuate. They have stock in the investment banks, or they used to work at the investment banks that are helping to promote these frauds and are making hundreds of millions off these frauds. And then what happens is the stock bubble pops, and the tide goes out, and you get to see who's wearing swimsuits and who isn't. And I think that's what's happening now. Mm-hmm. But as we were talking, and I was talking about this with a colleague just yesterday, in fact, when's the last time, outside of Madoff, when's the last time has a big Wall Street promoter gone to jail for stock fraud? Mm-hmm. You have to go back to Michael Milken and Ivan Boesky, probably. And maybe you could say Jeffrey Skilling, but from Enron. Enron's another good example. Everyone knew Enron was a Ponzi scheme and it was a fraud. But the SEC didn't, the SEC didn't see anything to crack down on there until Enron had already hit the wall. And most of the rating agencies didn't either. I think Moody's had Enron rated as investment grade up until about a month before it hit the wall. So I think we're starting to enter a cycle like that right now, another cycle like that. Again, we haven't, the SEC's looked the other way on all of this stuff. They could have shut down Elon Musk. I'm not saying they'd shut down Tesla, but they could have shut down Elon Musk when he was doing his, remember the 420 funding secured thing, when he talked about taking Tesla private. They could have removed him completely from Tesla and the financial markets back then, but they didn't. They looked the other way because mm-hmm. Goldman Sachs and Morgan Stanley make too much money off Tesla for them to shut it down. I think right now a good example is Carvana. Carvana's it's embedded with more financial fraud than Tesla is. Carvana is just, it's a walking roach motel that the founder and his son, the CEO, used to extract a lot of cash from. I've always said, as soon as the financial markets stop funding Carvana's financings, it's going to blow up. And we may be seeing that happen right now mm-hmm. because they're trying to do a big financing to get an acquisition done, paying an idiotic price for the acquisition. They were able to get the stock deal done because the founder of the company and his son bought $400 million of $125 billion, a $1.25 billion deal. So stock deal got done, but they're trying to do a PIK preferred issue, $2.25 billion, I think, and then a junk bond issue. I think it's $1 billion junk bond issue. It might be a little larger. And my understanding is that it's struggling right now. A PIK preferred financing to do an acquisition. You haven't really heard about a security like that since the Drexel days, because the market just wouldn't tolerate it. And if the market balks at doing this deal, Carvana is going to fall a lot further than it's already fallen over the last couple months. And to me, that'll be an indication that the market is actually doing the job the SEC should be doing. So what will happen is the market will stop funding these Ponzi schemes. They'll collapse, and then all of a sudden the SEC will ride in on a white horse and crack down on the perpetrators.
Well, like you say, Dave, there's never an absence of things to pay attention to and to keep our eyes on. But I appreciate you sharing those with us today. Is there anything else you'd like to touch on before we wrap up? Again, people probably accuse me of being a precious metals permabull. I think over the last, you got to have a long-term view. Over the last 20 years, gold has been the best performing asset. There's probably some obscure assets that have performed better. Silver has been like the second or third best performing asset over that time period. I would just, I tell the audience, don't get discouraged by what you're seeing out there right now. Mm-hmm. Hopefully you've raised cash over the last several months and you have
cash that you can use to take advantage of this sell-off, because I really think we're going to see much higher levels in the precious metal sector within 6 to 12 months from now, if not sooner. And I'm just not blowing smoke here. I put my money where my mouth is. I have almost all of my entire investable net worth in the precious metal sector. That plus puts on Tesla and Carvana.
Dave, of course, you're available. More info from you at investmentresearchdynamics.com. Mining Stock Journal and Short Sellers Journal are also available from there, right?
Yes, that's correct. There's 2 links, and you can there's descriptions of what you get when you subscribe.
And of course, on Twitter, you're at INVRES Dynamics, right?
Yes.
Perfect. Dave, thanks so much for your time today.
Thank you, Tom. Thanks for having me on again. I appreciate it.
Anytime. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.